This is to do with the post-Bretton Woods 1971 situation where the United States has dictated what money is through the use of force and other means. And things may be about to change very dramatically, which I think will have quite an impact on virtually all the markets that we look at. This is J. Taylor Media, where you can listen to my weekly radio show. You can go through there to listen to it live at 3 o'clock Eastern Time every Tuesday between it's Pacific Time, 12 o'clock and 1 o'clock. I have a lot of very interesting guests and some mining companies there as well. Some of you here listen to my show. I've met a number of you already today. So you can access my show there, or you could, the following day it's a podcast as well. So J. Taylor Media, or for my newsletter, it's miningstocks.com to sign up for my letter. But we are offering a 50% sale. So for $99 you can get an annual subscription. But you need to call my office at 718-457-1426. 718-457-1426 to sign up for the 50% off deal, because we can't do it on the internet. Just tell them that you were here, and my wife or whoever answers will give you the discount. Just I had to put this one up because last year about this time I invited Novo Resources here, and they hardly had, there wasn't much attention. Quentin Henning was standing out there on the end pretty much by himself. Nobody was paying too much attention. Then it was a story that I liked a lot and was pounding the table for it, largest holding that I had, and got lucky. So but this is really why we're here. We're looking for companies that can find phenomenal deposits and make new discoveries using new ideas. And I think you'll want to hear what Artemis has to say here. They're, of course, involved in that very unusual discovery in northwestern Australia. Well, let's get down to my talk. The petrodollar and gold, which way now? Just a little history here. Of course, Bretton Woods, 1944. The world was on a gold standard. It was $35 an ounce. Fixed rate currencies around the world. One problem for the United States and its ambitions to become a world power, to become a bigger world power. How could you pay for Vietnam and socialism, all of that, on the gold standard? So the United States, being in the position it was in, Mr. Nixon said, we're not going to honor our commitment under Bretton Woods. And we started to have a floating rate regime, and the United States started printing money like mad, as you'll see from some slides and as you're well aware of the growth in the money supply. The problem with that is, well, Nixon had a choice. He could have been honest with the people and said, the Vietnam War is going to cost you money, we're going to have to tax you. Socialism is going to cost you money, we're going to have to pay for it. Or he took the easy way out and he said, we're the United States of America, go to hell, we're not going to honor our commitment on $35 an ounce. But then what gave the dollar any value? Why wouldn't all the countries around the world run away from the dollar if it no longer had any intrinsic value? And that's where the diplomacy and the power of the United States came into play. Henry Kissinger runs off to Saudi Arabia, works a deal with the Saudis to protect their regime militarily, and in exchange for their sale of oil in dollars, and that all of OPEC would need to do the same thing. So what that does then, of course, it means that everybody around the world has to have dollars if they want to buy, any oil importing countries at least. If they wanted to import oil, they'd have to have dollars. So for example, if Bolivia has to import oil and it sells bananas to Norway, Norway has to get dollars then. They all have to have dollars. And that's what this deal did with Kissinger right after 1971. So really, in my view, is a morally illegitimate currency, because it really is saying the United States is forcing other countries to take dollars. The IMF and World Bank made it impossible, said you're not allowed to use gold for your currency. So it was really a rigged deal. It was rigged to try to make the dollar the world's currency, the world's reserve currency, which of course it has been and still is, although in decline now, I believe. So what we've engaged in then is military action when diplomacy doesn't work. Examples would be Iraq and Libya. Alan Greenspan said, "I'm saddened that it is politically inconvenient to acknowledge what everyone knows. The Iraq war is largely about oil." So Saddam's crime was wanting to get paid in euros instead of dollars. Gaddafi's crime was wanting to do the same thing and also set up a Pan-African gold-backed trading system. Not good. It's not a good outcome if you try that stuff. Just with the freeing up and the ability of the United States to print infinite amounts of money, seemingly, although I think those days are coming to an end, it meant that the United States and its allies could dominate the world scene by military action, and that the orange part there is the United States and its allies compared to China, Russia, and Iran in blue, and the other countries in red. So the United States went off the gold standard so that it could do this, so that it could basically dominate the world and control and change regimes. In the process, of course, we created enormous amounts of money. This is the monetary base, the Federal Reserve's monetary base. Note the difference from 1918 to 1971, 43 years, the monetary base grew 14 times. But from 1971 to, that would be 2017, a mistake there on the slide, 46 years, it's grown 44 times. So a massive growth in money creation, not in value, not in wealth, but just in units of currency, which of course then led to the 2008-2009 financial crisis. We all know about that. Huge loss of jobs, massive amounts of money, wealth that went to money heaven. I keep track of something called the global US dollar liquidity. It's a thing that an analyst at Merrill Lynch charted back in the Asian crisis, and ever since that I've been looking at it very carefully, and that's comprised of foreign central bank holdings of US dollars plus the US dollar monetary base. And here we can see the foreigners up before 2008 held, it was something like 73% of that measure of global liquidity, dollar liquidity. And after that, of course, with QE and everything, it dropped precipitously. Now we're down to about 45%. So foreigners are not owning, are not holding the dollars that they once held, dollar liquidity, the liquid dollars that are sloshing around the markets. In the IMF, of course, the SDRs, China in recent years has kicked and screamed about not owning more, not having more weight in the SDRs in the international monetary system. So you can see there that the US dollar, the euro, the Japanese yen, and the British pound, allied countries, having the dominant position at the IMF in the SDRs. Now, China and Russia are clearly fighting back, and they're doing it in several ways. They've been accumulating huge amounts of gold, massive amounts of gold, some through mining, but also through importing massive amounts of gold. And so the idea is that, you know, the gentleman there, an economist from China, is suggesting that the instability is directly caused by the United States printing press, and it has to change, and we need to go to a global monetary system. And Mr. Putin also is complaining about the imbalance of the countries with far more wealth are not represented in the global scene through the IMF. This is a chart. The blue chart is from Bullion Star. The blue bars are from Bullion Star, which I believe is far more accurate than the dark blue that's put out by GFMS. And you can see that the massive amounts of gold that has been moving into China. It's just, you know, over 2,000 tons per year, a couple of years there, just shy of it the other couple of years. So China's been building a massive amount of gold reserves. And here we have the gold miners, of course, South Africa coming off from where they were in the past. But China now, according to this, my friend Jeff Dahl was telling me yesterday that he believes that China may have been overstating the amount of gold they mined, but understating the amount of gold they imported. Whatever the case is, they're building huge amounts of gold up in China. And that's one of the ways they're fighting back against the petrodollar. So there's a lot of things that are really changing globally and geopolitically that I think we need to be aware of, because I think things are starting to happen in the post-Bretton Woods era geopolitically. You know, I mentioned the 10% SDRs that China has. China funds the new Silk Road, or the one road, one bridge infrastructure. Not only that, but the banking and financial infrastructure that's being created between Russia and China and Iran and other countries. When the United States threatened Russia with sanctions and take away the SWIFT system, well, the other people, China and Russia and those countries decided they would build their own SWIFT trading system so that they could move money around the world. There's just a lot of things happening. Saudi Arabia is now the largest, or China's the largest buyer of Saudi oil right now. For the first time ever, the Saudi king visited the Kremlin. And China is demanding that they pay for oil in yuan. And if Saudi Arabia doesn't like that, they can easily go to Iran and Russia, who they're very eager to sell oil to China. And they'll take yuans that they can then exchange into gold now that China has in Shanghai, both a petroleum trading market as well as an oil trading market. So these countries are fighting back big time, and it's going to have very profound influence, I think, on the various markets. There's a number of things that are taking place in the global scene that are really important that we never hear anything, very little about in the mainstream media. You know, Putin has been accumulating huge amounts of gold too. He's quadrupled to 1,700 tons. The main point here is that reserve currencies don't stay forever. And you see, going back to Portugal, they last maybe a couple of hundred years, 100 years or less, 50 years, whatever. They don't last long. And the United States is getting a bit long in the tooth. So interestingly enough, in 1988, The Economist, certainly not an uninfluential publication among the mainstream, was suggesting that by 2018, we would have a new currency regime. We shall see, but it seems to be moving in that direction. Listening to Gwen's talk this morning, and she addressed the relative value of markets and so forth, I see here, this chart shows the Goldman Sachs commodity index relative to the S&P 500, and wherever you see the green circles, that's when commodities have been underpriced, and the extent they've been underpriced, you can see massive underpricing compared to the S&P. So certainly, stocks are extremely expensive relative to commodities from a historical basis. Gold, even more so if you measure it in terms of the monetary base. Think about the trillions of dollars that were created out of thin air to bail us out of the 2008 crisis. I think gold is looking extremely undervalued right now relative to, remember, it's not that gold gains value, it's that the currencies are debasing, they're losing their value. Gold stays constant, the currencies are losing. So you need to own gold as your savings, especially when you get in zero interest rates or close to it. The real problem I see is that Gwen talked about this a little bit this morning, the whole notion you can't raise rates because of the enormous amount of debt. And it's true, $20 trillion of federal debt now, and at nearly zero, $300 billion a year in interest expense. Now, what happens if rates start to rise dramatically? The U.S. budget gets blown out of the water. But I really believe it's not the Fed that controls the rates. I believe it's the markets that control the rates. For the longest time, we always felt that America could continue to live beyond its means as long as the savings nations, Japan and China and others, were willing to buy our treasuries. We could keep on spending and living like there's no tomorrow and let the rest of the world work and pay for our way. But that's changing, as I just mentioned. China and Russia, they're doing business in yuan and other currencies now. They're trading gas between the two countries, petroleum and so forth. They're not using dollars, they're using their own currencies. So actually, I think it's within less than 2 months now that China will be starting the petro yuan, or this whole ability to open up the markets with non-dollar trades backed by gold. So I think that we could be seeing a real tectonic shift in the markets this year, in part because rates have to go up. The Fed won't have any control of it. They have to go up because nobody's lending to us. So what's the Fed going to do? Is it going to allow rates to go up like Volcker did in 1980 to 17%? I doubt it. I think they're going to print. And I think you're going to see a massive inflationary problem that I don't wish for sure. I don't care how high gold goes, the havoc that it will be caused by that not to look forward to. I run something in my newsletter called J. Taylor's Inflation Deflation Watch, and it seems to be breaking out. I don't have time to get into the details of it, but it's a composite of global equities and also key commodities, oil, copper, silver, and the Rogers Raw Material Index is in there. So I think we're on the verge of a major breakout. And I've always been a deflationist, those of you who've known me for the years. But I think, as Ron Paul said, they can always print more money and hand it out. And so I think that's where we're at now. I just show this slide to remind us what happens in the cycles for gold. When we're in a bull market for gold, which I firmly believe we're in, you have 500–600% gains for this for the indexes. But then, in a very short order, you lose 80%. So my interest is knowing when do I get out of these things. And this is just a chart showing, again, this is the gold price, the year-end gold price. You can see since Nixon took us off when he closed the gold window in 1971. Now, Michael Oliver is an analyst that I use. I have him on my radio show almost every week because I haven't found anybody that's as good as Michael in terms of helping me know whether I should be in a market or not. He's not particularly good for short-term trades if you're a short-term trader, but it's olivermsa.com, or listen to him on my radio show almost every week. He's on for a few minutes and he provides updates. He has really turned bearish on the S&P 500, the bonds, and the dollar, bullish on the euro currencies, but gold, long, and GDX, as well as the commodity complex in general, and he's particularly bullish on the soft commodities going into 2018. All right, so we get to our companies that I've invited to the show. Genesis Metals will be talking to you in just a minute. 71.9 million shares of stock. I think they have a small resource at this time. I expect it will grow. We'll hear more about that in a couple minutes. 300,000 ounces, but a historical resource of 540,000. I believe they're going to be twinning some holes and probably be able to move those numbers up, but Brian Groves will talk to us about that. There's something like 10 zones that have yet to be tested. They're in the Abitibi Greenstone Belt, shallow targets, and so I think it's one that I'm really watching very carefully. Now, Corvus Gold has been probably the most exciting stock outside of Novo that I watch. But Corvus in the last short while, a very nice run here based on some drill results from the Mother Lode property that they just picked up recently. And it's only 6 kilometers away from the North Bullfrog, where they have a 1.7 million ounce resource, low-grade oxides. A PEA that they did was quite robust, but I think the prospects look much better now and possibly really, really good. Even some Carlin-style mineralization potential there as well. So that's one I'm really excited about now. New Range Gold Corp is located actually in the Walker Lane area of the Walker Lane district or the trend in Nevada, where Corvus is located in the same trend. But New Range has picked up a number of old gold mines, and they've consolidated a whole number of them, and they've had some really exciting assays that have come out in the first exploration that they've done. I think it's one, 71.9 million shares. I think it's one that I'm really excited about the prospects for this company as well. Now, I'm mostly known as a gold guy, but I had a subscriber of mine in Hong Kong, who's a former mining analyst, send me an email and said, you got to take a look at Canada Zinc Metals. And I said, all right, I have another one I got to work on, I got to look at. But when I started looking at it, I said, yes, I have to look at this. I think the numbers, the values, they're in, the Cardiac Creek is the name of their project in the Kachiki belt of northern BC. They have 140 kilometers of strike of this zinc belt. And yeah, it's just quite a story. The high zinc to lead ratios, they're going to be doing a PEA in the not too distant future. More drilling going on now, so we'll learn about that one in just a couple of minutes. That really, perfect timing here, I'm out of time. J. Taylor Media to catch my radio show every Tuesday at 12 noon Pacific time, or listen to it the following day at jtaylormedia.com. Also, if you want to take advantage of my half price for my newsletter, call 718-457-1426, 718-457-1426. Thank you very much.